Hello, my name is Jack Elder, Senior Director for Advanced Planning for Comprehensive Brokerage Services. Today is part 4 in our series on intentionally defective grantor trusts. Today we're going to talk about grantor trusts and a gift and estate tax navigation tool called Split Dollar. So to recap where we've been, in our first installment, we covered grantor trusts, foundational information of grantor trusts. In the second episode, we covered strategic gifts that need to be made before 2026. In our last episode, we covered installment sales, which is a great way for business owners and those that own capital assets to make significant wealth transfers and while minimizing avoiding estate gift taxes. Today, we're going to talk about Split Dollar, which is a life insurance application for funding a policy without gifts. So let's jump into it. What is Split Dollar? Why Split Dollar, and how we can help? So the question of why Split Dollar, or what is Split Dollar? It's when two parties share in the rights and responsibilities of a life insurance policy. So it's a strategy for using permanent life insurance to benefit two parties. So conceptually, it's pretty easy to understand. We have a plan sponsor. Okay, and that plan sponsor could be the grantor, making with their trust. It could be an employer and an employee, an employer and the employee's trust. It could be a business owner's business. It could be a relative of the insured. It could be another trust that the insured is in some way connected to. The plan sponsor advances premiums into who's going to be the ultimate policy owner in exchange for interest and the promise to be repaid. Now, there's two different types of Split Dollar. We're focused on loan-based Split Dollar, and this is the general how it looks. If the grantor and the grantor, if the grantor trust is a grantor trust as to that grantor, from an income tax perspective, they're the same taxpayer. So this is why this is under the intentionally defective grantor trust series, because what it essentially means is that interest payments from the trust to the grantor are income tax free. From an income tax perspective, no transaction has taken place. Now, from an estate and tax perspective, transaction has taken place. That insurance is going to be outside the estate. But the interest on these, call them intra-family loans or loans to the trust, that interest is income tax free. There are an infinite number of planning possibilities with this tool. I'm going to focus on loan regime Split Dollar in a very traditional sense, just to lay kind of the groundwork. But take it from me, you can do a lot of cool stuff with Split Dollar if you know what you're doing. So from an interest rate perspective, there's two different loan types. There's a demand note and a term note. A demand note uses a floating rate. It's published by the IRS each July. Because interest rates are on the rise, it might make sense to use term notes. Right now, those are the term note rates as of November 2022. They're published monthly by the IRS. So let's look at an example of a case we just finished up in November, so you could see how it works. So meet Abby. She's high net worth. She has an import-export company. Really, she's kind of a broker herself, and she markets products on eBay, Amazon, Overstock.com, and similar websites. She's already used her lifetime exemptions, and she's using her annual exclusions, the per donee gift of, she's using that for something else. So we have no ability to use gifts for life insurance. And she says she has a $500,000 budget, but importantly, that's an annual budget. So it's, like I said, it's a great case, great client. But importantly, she wants to use those funds. She likes the idea of funding a life insurance policy and then getting the money back, which is essentially the definition of Split Dollar. So she agreed she could advance the funds in exchange for a promise and a plan to be repaid. So our goals and challenges. She wants the maximum death benefit she can get. We can't use any type of gifts for the premiums. We can use loans, but principal, she wants to see that get repaid. And the trusts we're using already has assets in it. So we have a means to pay for the interest payments. Even though they're not taxable, we're going to actually pay them. So here's the deliverable we used. Don't get intimidated by row columns. I'm going to go through it kind of one at a time. There's the face amount on the policy. That's the cash value, and that's the premium. So right now in the red box, that's the life insurance policy. Each one of those premium payments is characterized as a separate split dollar loan. So who's making, seven $500,000 loans? Each premium payment represents a loan. We're designing this as an interest-only loan with a balloon payment when she retires at year 65. So she's going to contribute $500 a year to the plan. We're going to roll up the principal, interest only, and then note fixed interest rate at 2.97%. That was the long-term rate in November. The trust is actually going to pay that each year. Now, that's not required. You could accrue the interest. You could make annual gifts as long as they don't match exactly. There's some hoops to jump through. You can make annual gifts. You could have made a seed gift to the trust to handle the interest. Lots of ways to address it. Fortunately, in this case, she'd already done some estate planning that we were tapping into. And then she's going to roll out split dollar term, terminate the split dollar, roll out of it when she retires by withdrawing 3.5 million from the life insurance policy. You see where I've got it bracketed there, to pay herself back. So it's a circular transaction. Obviously, at that point, the interest payments stop. One of her goals was the biggest death benefit she could get outside of her estate. We managed to design this so that there's about $24 million death benefit at her life expectancy, age 84, with a $0, no annual gifts, no seed gifts. Now, we're paying the interest. But remember, because this is a grantor trust, that interest is not income taxable. So it's literally a circular transaction. But because this is effective for estate tax purposes, note that any outstanding loan would be included in her estate. So it's paid off in year, when she retires. At that point, it would not be interstate. But if, God forbid, she passes away, in 10 years, 3.5 million that she's advanced, 3.5 million note receivable promised to be repaid is an asset within her estate. So let's look at her transaction the way we looked at split dollar in general. You have Abby. She sets up a trust. Actually, she already had it. She advances premiums to that trust, $500,000 a year for 7 years. Her tax-free interest payments at a fixed rate of 2.97%, with repayment coming at her retirement. We are following all the steps that the IRS has laid out for us. And what do we accomplish? Well, she's got $23 million inside the estate at her life expectancy. She paid no gift taxes. She will, as long as she survives until she retires, she'll pay no estate taxes. There are no income taxes because this is a grantor trust. And from the Internal Revenue Code perspective, from an income tax perspective, nothing has occurred because this is an intentionally defective trust. But for state tax purposes, something big has happened. We got that 23 million outside the estate, and we preserved her estate tax exemption, gifting ability for other assets. So if this interested you, if you have clients that you think high net worth need to create liquidity outside their estate, gifts aren't the right solution, or gifts aren't going to be enough to cover the premium, we'd be happy to help you. We use everyday language with clients. We'll be as detail oriented as we need to be with your client's professional advisors. And I'm usually working with the attorney, CPA, maybe a trustee, who will be extremely detailed in that scenario. We have robust modeling. You saw one of the pages from that, where it tells the story in a mathematical perspective. Like I said, I'm generally working with the client's other professional advisors. We provide that point of sale support to help you get these types of cases done. And then we also help from an ongoing administration perspective to make sure that the split dollar doesn't get on track. So our deliverable and our support is actionable, and it can be co-branded. So if you want, we could put your logo on it. So that concludes our discussion of split dollar. Our next installment is going to be, how do you use grantor trusts in combination with premium financing in a rising interest rate environment. Premium financing is not dead, but you got to be better at, you have to be good at it. For the last 10 years with low interest rates and increasing asset prices, we've made premium financing look pretty easy. The next 10 years may not look like that. And so you need to have a rollout plan outside the life insurance policy. And grantor trusts and planning with grantor trusts can help you get there. And that's what I'm going to cover in my next installment. So with that, please feel free to reach out to me or to CBS on your complex cases. We'd be happy to help you. You see my contact information's right there. Thank you very much, and look forward to working with you.